secret to wealth is to own nothing and control everything. And we're very passionate about providing education. In fact, it's not about ownership that defines wealth. It is about control.
Mindset is very important when it comes to wealth.
We specialise in helping business owners who love their families. So when we look at inheritance tax side of things, a business owner is probably the one that's going to have a higher tax bill.
Sure.
And most business owners don't tend to have an exit plan, so they think about the exit when it's that stage of life, like, oh, I better think about stepping down, or
Sure.
my children need to inherit stuff. And at that point, it's normally too late.
What is a will?
A will should be bespoke to the individual, to the family. It's a type of trust, actually. It only comes alive when someone dies. If you don't have a will, you're actually given one by the government.
It's bizarre if you were happy and content that the government is making the distributions for you as they want.
Yeah, cultural background can have a very negative stigma on talking about money. Trying to re-educate, reframe the mind to let people know, look, this is actually a positive thing. Once people have done their will, they feel a weight is off their shoulder. I can't prove it, but I think people actually would live longer. There's one thing to think about once that planning's out of the way. If you own it legally, then they can tax it and they can take it. And so ultimately, if you know how to separate and divide the ownership, then you can still have control.
I think one thing people are missing out when it comes to advisors is the whole thing around, if you're settling a trust for your children, but they are still under the age of 18, then you have an issue.
Yeah.
Welcome to another episode of the talkin.TAX podcast, brought to you by your host, Omar Aswat, Chartered Tax Advisor. And today we are in the city of Leicester shooting a special episode with a special guest, Richard Ansah from Once Wills and Trusts, based in London. Richard, pleasure to have you on.
Thanks for having me.
Thanks for coming down. We're lucky that the train station and this studio is literally 2-minute walk, right?
Literally.
Yeah,
so it wasn't too bad to get here.
Not too bad. So yeah, pleasure having you on. And it's we've known each other for a good few years now, working together, providing service and value to clients. And just before we started shooting, we sort of touched upon the fact that these days a lot of clients are looking for the more a personalized service, which, to be open, they don't always find with the larger firms. Sure. Usually with the larger firms, just another number. Yeah. So what we've spoken about over the years as well, which is that, the personalized approach, personalized service. Before we get into the discussion around wills, trusts, the types of trusts, inheritance tax planning, I'm pretty sure you viewers would be engaged on those kind of aspects, which is very important, which is a necessity in this day and age as well. Why don't you tell us a bit about yourself, please?
Yeah, so I'm, again, thank you for having me on the podcast. I'm honoured to be here. I'm an inheritance tax and trust specialist. We run a firm based in London called, I said, Once Wills and Trusts. Once stands for own nothing, control everything. Our philosophy is like, the secret to wealth is to own nothing and control everything. And we're very passionate about providing education. In fact, I think it's our mission to kind of disrupt the legal industry in the space of the private client world by providing robust and bespoke education to the general masses who want to learn how to protect their family and pass down their wealth efficiently. So that's what we specialise in, really.
Okay, very interesting. I didn't realise Once stands for
own nothing, control everything.
Okay, so can you just elaborate a bit, please? What from what angle are we saying that?
So I first heard the quote from I don't know if it's either David Rockefeller or Kevin. Different people attribute the quote, but this is probably 100 years ago or so, and he made something like 300 million in a year, and he was asked in a report, how do you make that kind of money and not pay a single penny in tax? And his response was, the secret to wealth is to own nothing and control everything. Okay. And that's always stuck with me for donkey's years. So when we established the company, that's what kind of was on my heart.
Okay.
And that's kind of where it came from. And I've learned kind of the hard way that, especially in the Western world, it's not about ownership that defines wealth. It is about control.
Sure.
So we talk about trusts and vehicles that allow you to separate ownership versus control. Which we'll talk about more, I'm sure.
Sure.
Then we'll get into the realms of how real wealth is how the game's been played, really.
Sure.
So you can learn the rules.
I think mindset is very important when it comes to wealth. Something that I always think of is sometimes people, they work, as in, to be open, they work very, very hard on a daily basis. But if your mindset is not there, you really won't move up to the next level. Obviously, we're talking about life now. We're not really talking about taxes here, but yeah, that's very interesting. Own nothing, control everything. So yeah, that's quite interesting. In terms of the education side, I'm totally for that aspect as well.
Yeah.
For example, on LinkedIn, I like to educate my audience. You know, whether you win clients from your educating activities or not, doesn't really matter. As we said before this episode as well, it's not, you know, there's a bigger picture, and educating is a key part of it. What sort of things do you guys do in terms of the whole education side?
So we don't hold anything back, to be fair. We provide information which we believe is vital for families. We specialise in helping business owners who love their families. Why business owners, I get asked? Well, because, as you said, they work very hard. Not that professionals don't. But they, in terms of wealth and addition of assets in their life, they've got a business, they probably have a large home with a mortgage, they've got savings, they've got investments. So when we look at inheritance tax side of things, a business owner is probably the one that's going to have the higher tax bill.
Sure.
And they work really hard, as they say. They tend to work hard because they want to do the best for their families. And most business owners don't tend to have an exit plan, so they think about the exit when it's that stage of life, like, oh, I better think about stepping down, or my children need to inherit stuff. And at that point, it's normally too late. So, and we also find that when we get clients that come to us with either they've got a will already or have no will at all, they're quite ignorant of the financial system and the law that exists in the UK. And the advice out there, unfortunately, especially in my world of will writing and inheritance tax advice, it's very limited. And so people trust their advisors, but the information that's been given is just very poor.
100%.
And so they think they're getting a good deal, and until they get the education to realise, oh, actually, I didn't know that. And the other side of it in my world is people class a will like a tin of baked beans. It's just a commodity. It's like, oh, it's a piece of paper, I'm covered. Whereas, you know, a will should be bespoke to the individual, to the family. So someone who's 21 and just starting life, the picture of their life is different to maybe someone who's 60 with a couple of £1 million and a few businesses and 3 or 4 children and grandchildren. So just because it says a will on the paper doesn't mean the contents within it and what it will do for the individual is going to be the same. And so people need to get an education around that. We find that's a very big challenge. So people buy on price rather than value. And so it's just trying to educate people.
Sure. And one thing I would add to that is it's a one-off cost generally, right? For clients.
If it's done properly.
If it's done properly. So I think these kind of things just generally you should look at value rather than cost.
I mean, we tend to review it every 3 to 4 years, but the will can only do so much, which I'm sure we'll get into. And that's why we kind of speak to professionals like yourself to look at other lifetime planning, we call it, to help out. So, yeah.
Sure. In terms of the will industry or the will writing industry, I've noticed over the years there are a lot of cowboys, a lot of scandals, you know, aggressive selling, wills and trusts as well. We'll come to trusts. You know, put your main home, the one that you live in, your main residence, into a trust. From a tax perspective, that doesn't always work. Any comments around that? General comments in terms of the industry?
Where do we start? I mean, I'm just like your chartered tax advisor. From the private client point of view, I'm a trust and estates practitioner, so we're step regulated, step qualified. So we specialise in inheritance tax as well as will writing. And yeah, you're right. I mean, the industry is unregulated, so there's some very good firms out there, but they're also limited in terms of the information they can provide. And the challenge is the client may not be aware of the limitation. And that's both solicitors and professional will writers. So, and I say, even on our marketing, whether they use our firm or not, go on the STEP website, look for a STEP qualified advisor to give you the advice that you need. Because some lawyers are not STEP qualified.
Sure.
So, but because they've got lawyers as their title, and I think we're programmed to just believe that lawyers just know it all.
Know everything.
Just like GPs, so we trust them implicitly. Yeah. Whereas if they're not specialists and you've got a very complicated situation,
sure.
Just like a car, right? You're not going to bring a Rolls Royce to a garage around the corner, right? You're going to go to the right mechanic or right showroom to get things sorted out. So same thing with your wealth. And so the industry is one where I think people just need to be aware of what they're getting into based on their personal circumstances.
Sure.
So again, equipping them with knowledge, they can challenge their advisors to make sure they're getting the right education and the right service.
For sure, 100%. STEP, CTA, when you're looking at accounting, ACCA, I think it's important. Even the tax industry at the moment is unregulated. So you'll have accountants, advisors at times as well. They haven't really, they have minimal knowledge on certain aspects, and they'll basically try to replicate what someone else has done for their client.
Right.
And that's like a recipe for disaster.
Right, I see.
Because every single client, whether you're an individual, a family, business owner, property landlord, every single situation is bespoke.
Yes.
As in, it doesn't make sense to have the same solution or implementing a solution that you did for someone else a year ago for a completely different family.
Exactly.
But some people have this mindset, obviously, because they're looking at fees and that kind of thing. Mm-hmm. But the bottom line is we've seen many horror stories as well, and you must have seen a lot as well. Where for example, in will writing, for example, what horror story can you probably think of?
Oh gosh, where do I start? I think the main one is when people have a really basic standard will. So, and they're making absolute gifts. And they've got wealth, so they might have £1 million house, substantial savings, and they just think, "Oh, I've got a will, I'm cool."
Yeah.
And then when I say to them, well, you've got a potential inheritance tax challenge, were you aware of this? Do you understand what a residence allowance is? And they don't know what it is, or if they've got any kind of liabilities or debt, they don't understand the probate procedures. Nothing's been explained to them, and the basic will just won't cover it. It's going to cause problems, and it's not going to cause problems for the individuals, and it cause problems for the family. And I see that pretty much all the time. It's horrible.
Yeah.
So in terms of shocking stories,
there's too many to.
It comes under that bracket of just very poor advice. And you're just wondering, I don't get involved with probate, but I can imagine a lot of probate practitioners, they probably see a lot of challenges.
What happened here? What went wrong here? Interesting. So if we start going into a few more of the technical aspects for the viewers, let's say in a sentence or two, what is a will?
So that's a good question. So a will is it's a type of trust, actually. It's a testamentary trust. So it only comes alive when someone dies, but it gives you control to direct your wealth in the way you want it to go and to whom you want it to go. Sure. And your wishes are then acknowledged. If you don't have a will, you're actually given one by the government. Okay, they're called the rules of intestacy. So the question is, do you want to have control of where the direction of your wealth goes, or would you rather have a third party do that? And it may not be what you want to see happening. It might cause a lot of devastation for your family. So the will itself allows an individual to control where their wealth goes and how it's distributed, and done in a very formal way. And only one document should exist at any one time in your life, which could be updated, but it only comes into play when someone passes away. But it really does help the family, for the individual who has a will to direct that wealth to their loved ones in the best way possible. And that's pretty much a surmise as to what a will is and what should we do.
Fine. So if we say that we have a will document, broadly speaking, on average, how many pages would this document be?
Again, it depends on the individual. So it could be a very basic will, which could be 2 or 3 pages. Just establishes the executor. That's the one who administrates the estate when someone passes away. You may want to have some certain gifts for heirlooms and anything of value, or giving cash if that's something that someone wants to do. If it's someone young, they might have digital assets, or not just young, anyone, but assigning maybe a digital executor for managing all of their assets in terms of photos and crypto or private wealth or anything like that.
Sure.
And then really the beneficiaries, who they want to benefit and how they want to benefit. And we talk a lot about the types of gifts that we make, because there's 2 ways in which you can make a gift, and we can go into that a little bit later on. But it can shift all the way to having a very flexible trust, very technical trust, or will, with trusts within it. Different types of trusts, from trust to claim business relief upon death, to trust to protect the assets of the family. If they're married, specialist trust for tax efficiency. If they're single, depends if they own a property or not. It just depends on the situation and the person's circumstances. That's what I'm saying. It's a very bespoke, document to fit every individual based on what they're wanting to do.
Sure. Okay, that makes sense. And I'm just trying to what I'm trying to do here is just trying to get into the real nitty gritty. So the viewers and myself as well in certain circumstances, we can understand exactly what actually is going on. So, so another question from there would be, okay, in terms of signatories, I'm assuming the individual writing the will, of course, they have to be a signatory. And then do you need, for example, 2 witnesses, or how does that work?
So you have 2 independent witnesses.
Okay.
There can't be a beneficiary, can't be related to the person, just someone completely independent to witness in this country under common law.
Sure.
That rule hasn't changed since 1837. Even during COVID, it was exactly the same. It has to be 2 independent witnesses. Nothing digital, has to be a wet ink signature.
Oh, even in COVID, it had to be 2 physical witnesses?
Yeah.
Seriously?
Yeah. So it's very interesting times. It has to be a wet ink signature. In Europe, it's different, but in here, we're very, very old school still.
Old school.
It's the trust at the end of the day. So it's a trust document. It just comes alive when someone passes away. That's pretty much the signature part of it. And the other side with the wills, which I think is super important to understand, is because people have different stages in life, and guardianship and parental control, parental rights, and who you give that to is so important. If it's not in writing, then again, that role will then pass to the local authority or the government. And most people don't want to have their family members raise their children. Dynamics may not be that great. And so, again, just having it in writing, probably the will is one of the best devices to just set that up.
Sure.
A lot of people are not aware of that. There's a lot of parents with children under the age of 18. So it's a very important document. Again, just when we talk about controlling wealth, it's not just about money, but your loved ones and who do you want to have benefited.
Keeping things in the bloodline is a very, very important aspect that we regularly see.
Yeah.
You might have, I had a case recently where the parents own a lot of properties, and son and daughter. And it was quite interesting in the sense that the son was having a tough time in his marriage. So parents were very concerned about, okay, these assets, where are they going to end up? Right? Which is a natural concern. He had one son as well, as in the son had a son. So, the whole streamline, keeping things in the bloodline is very important for families, right? So that was one angle. And then, I don't know why, but they didn't feel comfortable, as in the parents, they didn't feel comfortable telling me in our first few interactions. But then they also told me a few weeks later that their daughter has a terminal illness. So you know that's another angle now.
Exactly.
You have to keep things in a bloodline from that side as well. Or what happens? Her marriage was fine though, so it was like, okay, are we going to involve? So it's very, very bespoke, isn't it? And I think that's what people need to understand. I think one thing, if people take away from this episode, is just take that specialist advice. We're not trying to sell anything at all. You don't need to come to us.
Exactly.
But it's just for your own benefit, which is take the advice, specialist bespoke advice, not, you know, your cheapest option, because this is a one-off cost and it's a one-off document usually. I don't think it's like, you know, it's not a regular change, right?
No,
it depends on circumstances.
This is a major life change. It's not.
So take bespoke advice and you'll end up winning, right? In terms of rules of intestacy, can you just, I don't think people are aware of this as well, honestly, which is what happens if there's no will in place. So, I don't know, shall we map out a scenario or?
So, okay, well, I'm trying to think of a scenario. So, typically, when the intestacy hurts the most for either married couples, actually, even blended families, non-married, it doesn't really matter. So, it becomes a problem, especially when you own assets together. So if you own an asset together and you're not married, it's a challenge. So whoever passes away first, especially if you own a property together, even how that property is owned that's another problem. But
are we talking tenants in common versus joint? Okay, fine. So that's something else.
A huge problem.
Yeah.
But if that person passes away, then if they're not married, it goes straight to the children. Now, when you own, if children are around. If you own property together, that's a massive problem, because if the children are underage, then how it will typically work, you're going to a statutory trust, which is a basic trust. The trustees have no power. They're just holding the property on behalf of these children until they reach an age where they can make decisions themselves, which is typically 18. So say they wanted to sell the property, it's a very difficult scenario. It's very messy. If they... then you've got a situation where if someone gets married and then we go into tenants in common versus joint tenancy, that's a horrible mix. If it's a joint tenancy, by succession, it goes to the surviving spouse. If there's children involved with no will, those children could be disinherited if the surviving spouse gets remarried.
Sure.
So it gets messy. So the rules of intestacy, government wills, it's there for a reason, to have a hierarchy and a distribution, rules of distribution, but it can get very messy, especially when children are involved. If you're married, remarried, stepchildren, it sometimes just won't go the way you want to, how you expect it. And most people think, especially if you're in what we call a common law relationship where you're not legally married, that, it will go to my surviving spouse automatically. It won't be the case.
Thought, isn't it? Yeah,
it won't be the case. Then you've got dynamics where maybe if there are either other children or stepchildren, and if the family dynamics are not great, if there's no plan in place, it could go the wrong direction.
Sure.
If you don't get on with your siblings, it might go to them if you don't have a will in place. So you just got to just understand the rules and say, well, is that what you actually want? And you can just go on the .gov website and just type in, and you can get the outcome of what it looks like. And I'm sure you won't be happy with what it looks like. So hence why having your own will is so crucial.
Exactly. And it's exactly as you mentioned earlier, which is having the control.
Yeah.
As in, it's bizarre if you were happy and content that the government is making the distributions for you as they want.
Exactly.
And you have the option, you have the opportunity. Yeah. And as you say, the rules of intestacy are only there because you need something to fall back on.
Yeah.
But, it's up to you now as a family to, be proactive. I think proactivity is a key word in all of this, even in tax planning.
Yeah.
Like, you can have business owners, there's so many once they come to us, we've seen so many missed opportunities, or so many opportunities they can go to now. And we've only realized all of this because the business owner himself or herself were proactive, And same with any kind of planning and proactivity. I think awareness, education. Do you feel like there's an issue? One thing I always say when it comes to inheritance tax planning is that there's you find that in certain families, there's this sort of uneasiness when it comes to talking about wealth or money, and also when it comes to talking about how is money and death and how is money going to be distributed, especially with, those on top of the chain, so the parents or the grandparents. Would you agree with that statement broadly?
Yeah, absolutely.
There's
some cultures, especially, I know my culture especially.
Likewise, the Asian culture.
It's very like, oh, you're trying to kill me off, and now's not the time to talk about stuff like that.
Yeah.
And really, it should be the opposite. It should be embraced. I think it's just down to cultural background can have a very negative stigma on talking about money, and it's trying to re-educate, reframe the mind to let people know, look, this is actually a positive thing.
Sure.
And most times, I would say 9 times out of 10, once people have done their will, they feel a weight is off their shoulder. I can't prove it, but I think people actually would live longer because one less thing to think about once that planning's out of the way. They know it's all sorted out. They can just relax rather than having in the back of their mind, oh, I better do something.
I would say that one statement, we should clip it out, make it into a reel, and it should go viral. How to live longer.
Right.
Right away.
Very true, very true. No, it is. I think it's important. No, I completely agree. And I think that's why education, again, is because people just don't know what they don't know.
Yeah.
And then when they realise, oh, I've not done this, and I better check out my circumstantial situation, then they can start to make an informed decision, getting the right information, and then they can decide how they go forward. Inheritance tax is not going to go away, as people can see. That doesn't really matter what part of the country you live in. Okay, down south, you probably be a higher risk of being affected than up north, but ultimately, people up north have still got a lot of properties, and it can be very easy to fall into the inheritance tax trap. So, money and wealth must be discussed. The longer you leave it, the harder it is to, because it is theoretically possible to plan to not pay inheritance tax.
Any inheritance tax, exactly.
But you need time on your side. Hence why you got to plan in advance.
Sure, exactly. In terms of the I think whilst we're on the inheritance tax topic, we'll just stay there. I wanted to sort of push into trusts, but let's talk about inheritance tax. And then, exactly. So for inheritance tax purposes, you have the one thing you mentioned was around the giving yourself time. So that was one thing, giving yourself time. But the other thing was you can potentially totally eliminate inheritance tax if things are done correctly and specialist advice is taken. When we're looking at time, usually we're looking at the 3-year rule, where you then have taper relief kicking in, or you have the 7-year rule when we're looking at lifetime transfers, something known as potentially exempt transfers and chargeable lifetime transfers. And that's where we start looking at trusts, for example. So why don't you just give us an introduction in terms of, again, in a couple of sentences, what are trusts? And then, can I take that one?
Go for it.
I'll take what are trusts, because I've memorized this. But then if you can then explain to us the different types of trusts. Honestly, as a chartered tax advisor, I'm still like, sometimes I just come across some random name and I'm thinking like, okay, what is this? And then you can correct me if I'm wrong, but usually it does come down to either discretionary or interest in possession, but we'll come to that. A trust, in one sentence, I've gone blank.
No, it happens. So
I'll leave it with you.
My version of what a trust is, it's a device that will allow an individual to control the direction of their wealth. It allows you to, what it does technically is separate legal title from beneficial ownership, or legal ownership for beneficial ownership. And pretty much the way I see it is if you own it legally, then they can tax it and they can take it. And so ultimately, if you know how to separate and divide that ownership, then you can still have control.
Sure.
And then allow the beneficial side of it to go down to your loved ones, so they have equitable or beneficial enjoyment of that asset over a period of time. That's my personal definition. I don't know about the technical one, but
that makes sense. I think that what the sentence that I was thinking of was actually combining set law, trustees, and beneficiaries in a sentence, which is a set law settles assets into a trust for the benefit of the beneficiaries, and the trust is legally owned by the trustees.
Yeah.
Does that sound about right?
Yeah. So, I'm not going to be a techie geek.
Fine. No, go, I think you should go for it. Go for it.
I mean, I love trusts. I've been something for a long time, and so the first thing, trusts actually reside in a separate jurisdiction, which is only really unique to a common law country. So it's called equity jurisdiction, and hence most technical books would say, "Oh, trusts came about after medieval times and the Crusaders going to war, and so they'd have to give their land for use." And so land used to get stolen because they'd be in war for a long period of time, and so they'd set up certain laws to allow their land to be protected. I can prove it goes back to biblical times, but I'm not going to go there today. But ultimately, as you say, the trust has a set law who settles their assets into this device, and then we can have someone who administrates the trust. And so the trustees do that. In equity, the true owner is actually the beneficiary. But in law, then the trustee has that heavy weight and they're the face of the trust. So therefore, that's where we can protect assets, because the trustee are the mouthpiece of the trust. And it's a very private affair. So their job is to benefit the beneficiaries. Now trusts are registered. That's the only way the beneficiaries are really divulged, and the trust registration is a very private registration service anyway. But other than that, no one would know who the beneficiaries are and what they're entitled to, except for the trustees and obviously the one who creates the trust, the set law.
Sure.
So there are different types of trusts. So you've got a discretionary trust, and what that allows the trustees to do is have full discretion, administrative powers, and just general powers to make decisions as if they were the settlor themselves. So it gives them the right to administrate and protect that asset as if they were you, but it's not you, okay? And but they have only legal title. They don't have beneficial use. So if a trustee technically went bankrupt, they don't own your asset. The trust does, and that's the different side of things. Whereas the beneficiary have the beneficial use of the asset. But the power of a discretionary trust is the beneficiaries, we call a hope beneficiary. They're not actually beneficiaries. They're just named, which is where the protection comes in. Okay. And so the trustee can then, almost like a puppet master, can decide who comes up when or if they come up at all. Sure. And then they'll know via, we call letter of wishes, which is what the settlor would write as what they'd like and hope to see happening. Okay. But the trustee, because it's discretionary, have the full power. And so therefore, it's very difficult for any third party to kind of interrupt that trust unless there's proof that the intention, and that's why equity comes in, because it's not about statutes and acts, it's about your intent and your mindset. How are you looking to benefit someone else? As long as your intention is clear and pure, then there should be no reason to disrupt that trust. So, for example, if you're deliberately trying to hide from creditors, or it's a sham, so you had no intention of doing what the trust is supposed to do, then the law will get behind it. But otherwise, it's doing its job. And then the second type of trust, which you mentioned, is an interest in possession trust. So it's kind of like a quasi-trust where you've got a discretionary element for the capital. So that's protected and locked by the trustees. But the enjoyment of that income or capital, the enjoyment of it or its use, the trustees have no control. That's purely down to the beneficiary's enjoyment. And so that has a lot of power in certain instances. And the third type of trust, we mentioned, is I would call it absolute trust or bare trust. Some people argue it's not a trust at all because the trustee is literally just holding this thing in their hand. They don't have any discretion, they have no control. And the beneficiaries can, when they reach the age of majority, can say, well, I want it back now. And the trustees can't even say anything. So ultimately, it has its use.
It's a look through.
But it is a look through. But it has its use with careful planning. So those are the 3 types of trust. So yeah, the marketing is rife and there's all these fancy names and everything else. Some of it is more tax related. Others are just purely commercial. So yeah, it's just trying to understand what is it doing, what's the purpose of the trust, and then we can work backwards from there.
Fine. So I wasn't going crazy then.
No, not at all.
Yeah,
There's a lot of confusion out there.
I thought, like, for example, like at the start, many years ago, I used to get confused. Like I used to say, okay, 18 to 25 trust. So I used to be like, okay, is that something completely different?
Right.
But no, that can be an IIP or discretionary, right? So yeah, so effectively everything comes down to these 3 that you mentioned. And then I think like maybe overarching the 3 would be something separate, but it's called a set law interested trust, right? Or where would you sort of...
So this is down to tax now.
Okay.
It's all tax now.
Sure.
So HMRC have obviously got their regulatory provisions in place, and so they've got involved with trust law. So ultimately, when a set law creates a trust and they have an interest in it, so they're the beneficiary as well, because there's 3 hats or offices in a trust. The settlor can be a trustee. The settlor can also be a beneficiary. It can't be all 3 at once unless there's other people involved. But there's different offices or hats. So if the settlor happens to also be a beneficiary in a trust, then it can be a bit complicated from a tax perspective, especially in inheritance tax.
Sure.
Because we talk about a main home, for example. If I have a pen, I've got no pen here, but if I gave you a pen,
sure.
Who's the true owner of that pen? If it's a gift to you, do you own the pen if it's your gift? Or do I still own it?
I own it.
You own it, right.
Once the gift has been received, yeah.
So if I'm still using the pen, but it's supposed to be yours, and now I'm saying, but I want to claim some benefits like paying no inheritance tax, for example, then HMRC is like, well, come on, you can't have your cake and eat it. So we're saying, well, that's a gift, but you're reserving that benefit. So we call it a settlor interested trust.
Sure.
And they're the ones that would probably where there is anti-avoidance rules around that. So the other type of trust is a non-settlor interested trust. And so the technicality of that is, if the settlor is a husband and the beneficiary cannot be the husband, cannot be the wife, cannot be a child under the age of 18, but can be a grandchild.
Sure.
So therefore, the settlor can have no interest in the trust besides being a trustee. So therefore, they can have all the tax perks in terms of inheritance tax benefits.
Yeah.
And that's a non-settlor interested trust. So yeah, I see where you're coming from. And then that's where the tax planning starts to get involved. And obviously there's other rules like lex situs and all that kind of stuff. And
I think,
and things like that. So yeah, then it's all tax based.
Yeah.
Rather than trust.
Which is good for our conversation today. I think one thing people are missing out when it comes to advisors is the whole thing around if you're settling a trust for your children, but they are still under the age of 18, then you have an issue.
Yeah.
So that's something that just sort of it just came to mind. I've seen that mistake happen a few times now, where it's been advised that you're under the age of 18 and therefore it's fine. I think the other angle would be around the tax concept of gift with reservation of benefit, which exactly as you mentioned is where you gift someone an asset, so usually a close family member. You gift someone an asset, but then you continue to enjoy benefit from that same asset. HMRC naturally will not be happy about that. And that's where you have anti-avoidance provisions, specifically known as gift with reservation of benefit. Do you want to talk us through, a typical example, perhaps the main home?
That's going to be the most common trip up.
Exactly.
So you live in your main home and, you've got children in the main home. And the common question I get, inheritance tax, can I gift this to my child?
You can do what you want.
You can.
Exactly.
But for inheritance tax purposes,
Yeah.
are you still going to live there yet? Well, then it's not going to make any difference. Yeah. So, but I heard this, and I'm saying, well, okay, I'm telling you for a fact. And that's the problem now in having non-specialists
Yeah.
talk about specialist tax
Sure.
instruments. So, with your main home, pretty much there's no way around it. Well, okay, there are caveats, but I won't go there just yet. But ultimately, if you live in that main home, if you gift it away and you're still living in there, like I gave it a pen example, you're still reserving the benefit. So there's no inheritance tax benefit.
Sure.
And the clock will not start in terms of when you make the gift, because you've got the 7-year rule, the clock will not start until either you're going to either rent that property out, so now you're not benefiting from it, or you move out.
Fine. Or the other caveat would be market value rent, right?
Yeah. So if you rent the property out at market value,
Fine.
and you're paying it,
Yeah,
at market
so-
value,
so, yeah.
then basically
Exactly.
you're outside of the rules.
Yeah, so that can be, for example, if a father, for example, gifted a property to his son, let's say, but he continues to live in the property, as long as he pays market value rent to his son.
Yeah.
So again, for the viewers, we're not saying that it has to be like someone external, an external, tenant. It's, between father and son, you have to pay market value rent. Now, one may think, okay, like, why are HMRC allowing that? As in, how come by you paying market value rent, you then move away from the gift with reservation of benefit and therefore benefit from inheritance tax savings? It's because when you pay market value rent to your son, for example, then the son has to physically declare rental income on his self-assessment tax return, and therefore he's paying personal income tax. So what you have to think about when it comes to taxes is that usually if there's a benefit on one side, there's a disadvantage on another side. And sometimes it's not only tax versus tax, sometimes it's tax versus control, for example. So you're benefiting from, for example, you're gifting assets into a trust, and therefore you're saving inheritance tax after 7 years, for example. But then you've lost control, right? Because as you mentioned, the beneficiaries are the ultimate beneficiaries. So it's just, different concepts that we as specialists, we can put together and ensure that nothing is overlooked.
Exactly. And then from an estate planning point of view, the exact same example, what type of trust would you use? Because some people just say, oh, well, just do a regular deed of gifts and set up a lease agreement or tenancy agreement and pay market rent. But what they don't realise is that if the gift is now made to the son, that asset is in the son's name. And if it's that type of a gift, the parents have lost all control.
Sure.
And the son now has an asset in their name. Then I ask questions like, well, say if the son gets married, are you happy that if it gets divorced, that wealth is now gone sideways, potentially by 50%, and you have no control? Or if he already owns other properties, he's going to have to start paying higher rates of stamp duty. So now we've got to look at different types of trusts, because you could use a discretionary trust in that instance. And so you're paying market rent to the trust as opposed to the son, and all this kind of stuff then comes out, giving people choice.
Sure.
And that's really what we're trying to help people
Exactly.
to do. But generally speaking, we tend you're not going to be saving money on the inheritance tax for your main home, unless, which is very, I say rare, certain communities it will benefit more than others. The children live in the main home. There's no expectation of them moving out anytime soon. Then the Finance Act, I think it's, if you don't quote me, Section 102, Section 103 and all the others, they're the rules that will allow to say, right, well, that's how we'll circumvent the gift of reservation.
Okay.
So then we can look at other ways of having inheritance tax planning.
Excellent. You made a key point just a few moments ago, which was around you then need to start, when it comes to the control aspect, you then need to start looking at different types of trusts And moving further away from trust, you can start looking at complete different mechanisms.
Yeah.
One being the increasingly popular family investment company route, which is a route that can be undertaken in order to begin the transfer of assets / wealth in a controlled manner, while still achieving the family objectives. So family investment companies is something that we look at together many a time. And I tend to feel that a blended approach, so family investment companies alongside the use of trusts work pretty well. Depends on circumstances as always. But yeah, in terms of family investment companies, what would your initial comments be for the audience?
So from a private wealth perspective, the challenge with trusts, traditional trusts, is that there's only so much you can now put in the trust without triggering a charge to tax.
Sure.
And life today, people's assets are far more than that value. So the nil rate band is currently £325,000 per individual. And for discretionary trust, or let me be technically correct, I know people try to correct us, a relevant property trust, so a lifetime trust created, the maximum you can put in there, the rules will trigger to save a maximum £325,000 before inheritance tax is due on that trust. So if you own property, the rules are very clear by HMRC that unfortunately investment of land is not deemed, or there's no relief for that type of asset. So it's going to be part of the shares will be formed part of your estate. If it's part of a company, if it's in your personal name, it's part of your estate. And so inheritance tax plan becomes very stifled, very limited. And if we're going to do a plan over every 7 years and you're starting at age 60, and I'm saying it's going to take 14 years before you have a reasonable chance of reducing your inheritance tax, bearing in mind we can't control how fast property values rise, it becomes a problem. 100%. And so adding 14 years to age 60, age 74, and we've got other aspects to control, it becomes very, very problematic to start helping especially property owners and business owners in that situation. So remember, the root of a trust is ownership versus control. So other vehicles that we can look to use are corporations. And so now it comes to be very, very, very specialist advice where you need someone like a chartered tax advisor, lawyers, etc., to understand how do we administrate shares. Companies are good because there's no limit to what value you can put in there. Mm-hmm. There are other complications that can come up. That's your specialty. But ultimately, now we can look to still have the same basic premise of beneficiaries, ownership versus control, limiting ownership, and then using specialist trust at the back end to wrap everything up nicely. So that's basically where we would look to use a financial investment company, and it's becoming more and more of a tool. Because of how rules have now changed. Exactly.
I think one of the key aspects you mentioned was around the fact that when we're looking at trusts, we can only, between husband and wife, transfer £650,000 because the nil rate band is currently £325,000. I just want to take a step back. A lot of people, they tend to not criticize me, but correct me online when I say inheritance tax is 40%. They say, no, it's after your nil rate band and it's after this and it's after that. Yes, we know that. But just for clarity purposes, yes, each individual has £325,000 nil rate band. And then you have something called the residence nil rate band, which is currently at £175,000, which between husband and wife can take you to £1 million. And then there are other reliefs as well. For example, coming back to the basics again, which is, the £3,000 per annum. But yeah, inheritance tax is at 40% following all that. And this is what we're talking about here. This is where you start looking at trusts, family investment companies. I think a key point that you mentioned was the fact that you can transfer £650,000, so we'll keep the topic to husband and wife, into a trust without any inheritance tax. We're talking lifetime inheritance tax. We're not talking on death. People, again, misconception or misunderstanding or just not knowing at all. is that inheritance tax is only paid on death. That's not correct. Lifetime, chargeable lifetime transfers in excess of the £650,000, you'll pay 20% in lifetime within 6 months. So there you have a problem, right? Properties, stocks and shares, crypto these days can easily exceed £650,000. So what are you going to do? Are you going to, say 650 now, wait 7 years, another 650, wait another 7 years, 650, but you've only still just reached 2 million.
Exactly.
Roughly about 1.95 million. Yeah. So if assets are worth over 2 million, or even above 650,000, you don't know about how long you're going to live for, right? Yeah. So then you have to start looking at other tools or mechanisms. And that's when you start looking at a family investment company. HMRC, they did look into these structures back in 2021. HMRC, they did look into these structures back in 2021, and they studied, they investigated, and then they closed down the unit. And therefore, effectively something that should be utilized, whereby you have excess amount of assets that need to be managed for inheritance tax purposes. The benefit of a family investment company, one benefit is, as you mentioned, any value can be transferred into the limited company. But what clients need to be aware of is that how are the assets being introduced? This is a very key aspect. Because, for example, when we're looking at a trust, it's just, for example, if you're looking at properties, the title deed moving over, right?
Well,
if
you be technical about it, with land, you've got the title and the value.
Sure. Okay.
So you can just put the equity if you've got a mortgage. That's another story. But because of land law, land itself can go into trust, and then the value can also go into trust.
Fine. Okay.
Yeah.
Perfect. So, as we say, the assets transferred into a trust, when we're looking at £650,000, no inheritance tax payable, and also no capital gains tax payable. This is why we limit ourselves to 650 a lot of the time, because not all the time, sometimes you might have to put more into trust. It just depends on circumstances, but 20% in lifetime and then maybe capital gains tax. So you just limit yourself to 650 and you're fine. With companies, you can put in 20 million if you wanted to, right? And if it's cash, you have no problem at all, because there's no capital gains tax on cash. So there's a key distinction, or there are multiple taxes that need to be explored and considered when looking at family investment companies. Depending on the assets, we're looking at inheritance tax, capital gains tax, corporation tax, because it's a company, stamp duty, land tax when we're looking at properties. But yes, it is a very valuable tool. And then at times you can have the discretionary trust that is potentially a shareholder in the family investment company as well. But all very bespoke, specialist area, and that's something that we can look after. In terms of tax planning, back to tax planning, we have, for example, why don't we talk through a case study?
Yeah.
So do you have something in mind? Sorry, I'm putting you on the spot.
Well, look, maybe it's a generic case study, but typically it could be, we stick to the married couple with children, and they've got a portfolio, let's say £4 million in property in a company or companies.
And should we say that's in excess of the main home, or? In
excess of the main home.
Okay, so let's say main home 1 million, should we say?
Yeah.
Fine.
And then they've got, let's keep it relatively simple.
Okay.
So where I come in is, as you mentioned, we'll look at dynamics, say the children are young, maybe a blended family, it's even get a bit more complicated to keep people thinking. So they're married, but husband's been married before, has 2 older children, and remarried, has 2 younger children.
You went straight into the deep end there.
All right, so he's got 4 children, and the wife has just got 2 children together with the husband. So now we're going to do some planning. Inheritance tax, the maximum we can do via the will will be £1 million. You've already talked about the fact that They've got their nil rate bands at £325,000 each, the residence allowance at £175,000 each. The £1 million comes because with married couples, and this is very important. Number one, a married couple or a married spouse can claim the allowance of a deceased spouse up to 100% if no gifts have been made prior to death. And number two, spouses are deemed as exempt beneficiaries for inheritance tax purposes, so they can gift as much as they like to each other. So we can use that type of planning in a will, maximum protection up to £1 million for inheritance tax purposes, and that's fine. And then we can also use trusts within the will to protect that, and also protect the shares of the husband for his 4 children and the wife for her 2. So at least the 4 children are protected from the husband's side and the 2 children are protected from the wife's side. Okay. So that's a nice, robust, flexible will, and that's fine. But it doesn't stop there, because they've got assets in the company of £4 million. Now it gets complicated because there's something called taper relief and tapering. And the tapering kicks in with the residence allowance because their wealth exceeds £2 million. So now they don't have £1 million of allowance, they've got £650,000. So they're going to pay even more inheritance tax. Sure. So now I'm like explaining to them these scenarios. Another scenario that's common in that situation is, well, you've got, let's say, a mortgage, a small mortgage still in the main home, no life insurance. And probate now becomes a problem because probate, I think it's 2013 when the law changed, but probate will not be granted unless debt is all cleared. Inheritance tax must be paid within 6 months, and any liabilities to a mortgage, etc., must be cleared in order for probate to be granted. And so most people think, I could just sell the house. But you're in this vicious cycle.
Very, very bad situation.
Because, you can't sell the house without a grant of probate, but you need a grant of probate to sell the house. So what do you do? So there are means, but it's very horrible, frustrating for the family, time-consuming, and expensive as well. So these are the challenges that we have. So then we speak about lifetime planning now. That could be something from simple as a life insurance policy to financial investment companies for complex estates. And we'll class that a complex estate because HMRC will investigate an estate like that.
Yes.
Which they call a complex estate. And so hence why the planning is so important. And having advisors who self-regulate, because if the proverbial hits the fan, there's a recourse, there's insurance. And so the family investment company then will kick in because we got to find out, well, what does this guy do a lot of work in the businesses himself, with the properties? Is it deemed as trading? Is it deemed as investment? All the questions you would tend to ask. Sure. How are we going to transfer the wealth, et cetera, et cetera. I hope it's a decent example. But I think
it's perfect.
It's one that I think a lot of business owners, property owners will find themselves falling into.
100%.
And they haven't considered the exit plan to pass on to the family members.
It's very true, and it's a great example, where you have like husband and wife, and as you mentioned, children from a previous marriage. That's that's something that we see. And then I think one key point you mentioned, which I really enjoyed. I'm a tax geek, so when you mentioned that once you go past the 2 million in total value of estate, the residence nil rate band begins to taper, and therefore you're losing 350,000 at 40% of saving potentially, or you're increasing your IHT liability. 350 at 40% is £140,000.
It's a big chunk.
So just because of that, and as we say, there is scope to reduce inheritance tax liability to nil, but this you definitely have to start looking in lifetime and as early as possible. Just throwing something out there is something, post-death, which is the deed of variation, right?
Yeah, but that's still limited.
It's very limited, limited, So, just in the last month, I remember, so in early December, I had 2 client calls, potential client calls, but it's like, obviously I don't tell them that you're too late, but it's like, oh, my father passed away 2 months ago, and this was his estate, and this has happened, and my mum's, she's ill, and there's 4 siblings. And I'm like, you know, I don't like to say, oh, like you should have come earlier. I don't like to do that because it's like, but you haven't. So it's, you know, there's no point. But it's, you know, but people are starting to realize though, because they're seeing others, you know, going through struggle, as you mentioned about probate and that kind of thing, selling properties, then paying capital gains tax and all that kind of stuff. So I think early as possible when it comes to IHT planning and seeking out a specialist.
Yeah, definitely.
You know, STEP qualified, CTA. Yeah, no, it's been a great conversation. I think the audience will definitely find beneficial, honestly. A lot of people are clueless. One thing I must say, and I don't know if you'll agree with me, is that the younger generation, meaning as in, you know, you have the parents with all the assets. So let's say they're in the 70s. And then when I say younger generation, I mean those in their 40s. They're starting to reach out more when it comes to IHT planning. Because they know that they're the ones that are going to have to pay the tax man. Right? Is that something you've been seeing? Yeah, it is. And people are aware, you know, it's in the news a lot about this, you know, wealth transfer and what do you call it now? We've got Gen Zs and Gen X and millennials, and I forgot what they're called now. You know, it'll come back to me, but ultimately this generational wealth transfer is going to take place. And one of the problems that I see is we call generational inheritance tax. So the children's inherited and pay tax, not done any planning, and then it's taxed again on the same asset. It's horrible. So why not stop it once? Like pay it once and just stop it. Once. Oh, okay, stop it once. Play on word, excuse the pun. But, you know, at least, again, with decent planning, we can at least, so I hear exactly what you're saying. I do believe that people are waking up a lot more now. Yes. Yeah. And they have to, honestly, like just looking at London, for example, like even if you just own the one property now, you're gone over $1 million, you know, most likely. So it's not hard. Yeah. So it's like, it's one of them situations where, honestly, we just want to help. We do. We just want to help. Yeah. It's like people are getting into as I said, that 2 calls last month. It's like they were complaining to me. Right. Like they were sort of seeking some sort of counseling from me. Like, this is our situation. I'm sure you can, like, what can you do for us? This, that, and, you know, what can I say? Okay, we might be able to look at deed of variation, but even that is like, is limited. It's very limited. Well, I find with deed of variations, you know, sometimes there's family dynamics that's not working because everyone has to agree. Everyone has to agree. And this one particular case, it's like, you know, there was like 6 siblings and I don't think they were on good terms because a week later I had another sibling asking for a call with me. So it's like, but your brother just had a call with me. So what's happened? Yeah. So I don't know, but it's messy. Yeah, it can get messy, and you know, it's important to look at things as early as possible. Yeah, definitely. You know, we can go on, Richard. We can. I think we could talk for another 2-3 hours, but producer over there has given me the time limit now. Okay. I think, you know, we've discussed Sharia compliant wills before, you know, on the phone. There's so much that we can discuss, right? So maybe we have a part 2 at some point in the next. Why not? Over the year. Yeah. How's everything going with you on TikTok and Instagram? I saw one of your videos had like 200,000 views or something. Yeah. We got 1 or 2. No, probably more than that, actually. Okay. In terms of the views, I'm blessed to have a really good business partner that can help with the marketing side of things. Sure. But TikTok is definitely a lot of people. You know, the demographic is perfect. People are watching, people are learning, which is nice. Instagram, we're on there. We're on Facebook. We're on YouTube. TikTok is our primary channel. Is it? Okay. Yeah. And people, as in viewers, are reaching out to you for this type of stuff. Yes. Okay, because that's very, very... The reason I asked about TikTok specifically is people have this misconception that you have Gen Zs on TikTok. So, for example, in this discussion, why would they bother about inheritance tax? Sorry to cut you there. Yeah. It's a funny story. A client called me saying, well, I asked him, how do you find out about me? He goes, well, I've got this 14-year-old niece. Okay. And he said, he said to her, I think she found something else for him. So he said, if you find any other companies that, you know,
send them my way. So he only found out because his daughter's on TikTok. So
Wow.
it's all about the younger generation, but they're still telling their parents.
Wow.
And what I'm finding about TikTok is people do refer or forward on for people to watch, and so people who may not be on TikTok will watch.
Oh
the
yeah,
first
like
time.
via WhatsApp or something. Fine.
And then say, oh, okay. And then so it is actually, people are
interested,
open.
and people are open. That's very interesting. Excellent discussion. Really enjoyed. I learned a lot, and I'm sure the viewers would have learned a lot from your expertise and your knowledge. Visit Wants, Wills and Trusts for your financial education firstly, and then if you need bespoke and specialist advice, then Richard is your man. Any final comments?
Just how I thoroughly enjoyed today, so thank you. Again, it's all about education for us. People, we want to make sure that people are learning. I'm sure what we talked about today will be very useful for people to open their eyes of understanding and be able to make the next step for their families.
Pleasure having you on. And in terms of ASWATAX, you can visit our website, Charter Tax Advisors. This was, I've lost count of which episode this is actually going to be, but don't forget to like, comment, share and subscribe, and we shall see you on the next one. Take care. Bye.
Cheers.